So we're officially in a recession. The GDP numbers just came back this morning and it was negative. Following a Q1 GDP decline of 1.5%, the second quarter also came in negative. According to most definitions, a recession is defined as 2 quarters of negative GDP in a row. Since GDP data actually looks backwards, that means we've been in a recession already for the past 6 months. But this particular economic environment is an odd one because not only do we have negative GDP growth, what we're actually seeing is unemployment at the lowest in 50 years. In other words, people are still getting jobs, and that type of behavior usually doesn't go hand in hand with a quote recession. We are seeing some weak economic data. Pending home sales fell 20% in June versus a year earlier. Auto loans now make up close to 10% of all consumer debt compared to 5% a decade earlier. And retailers like Walmart have recently cut their profit outlooks. This has caused the Fed to decide to raise the interest rate or the federal funds rate by 0.75% or 75 basis points. This would mark the biggest back-to-back rate hikes since the 1980s, but this wasn't exactly what the market was expecting just a few weeks ago. Today, we're going to break down everything that's been going on in the economy. We'll actually debate the question of whether or not we're in a real recession, what might happen over the next year, and what it all means for you. Today's video is sponsored by me. I am the sponsor for today's video, and I do have a free newsletter that you can check out called Hump Days. It's a free financial newsletter that we send out twice a week. The link will be down in the description below. So earlier I said that a recession is defined as 2 quarters of negative GDP. And while that is a good general rule to know, the official definition of a recession is much more than that. Now, perhaps in an attempt to get ahead of the news, the White House recently wrote in a blog post that 2 consecutive quarters of falling GDP isn't the official definition or the way economists evaluate a recession. This brought some controversy with some people going as far as to accuse the White House of gaslighting. But the White House isn't entirely wrong here, but they're not exactly right either. What the White House is talking about is the way that the National Bureau of Economic Research, or NBER, defines recessions. That's kind of funny. It's like Uber, but with an N, so NBER. They define a recession as a, quote, significant decline in economic activity. So instead of using the 2 consecutive quarters of GDP decline as a rule or indicator, they also look at a ton of other data, including real income growth, employment, industrial production, and retail sales in order to really gauge where the economy stands. Now, since these guys are tasked with officially declaring recessions, they can't mess it up. So what do? They usually will wait for a peak or trough in the business cycle before officially calling it a recession. Now, their whole goal is to not be wrong. By the time that the NBER officially calls a recession, we've probably already been in one for a while. The official recession call from the NBER doesn't usually matter to the markets or really for the everyday person like you and me. So basically, the White House's blog post is a bit useless, and by the time the organization that they trust actually calls if it's a recession or not, it won't really even matter. Instead, what we should look at is the economic indicators. Now, these are going to be the best bet to assess what the state of the current economy is in. After the Fed raised interest rates a few days ago, the spread between the 2-year Treasury yield and the 10-year Treasury yield inverted, meaning that the 2-year yield is now larger than the 10-year yield. This hasn't been seen since 2000 and is really important because inversions in the 10-year and 2-year spread have preceded every recession over the past 50 years. So the market right now is certainly already pricing in recession. Other economic data is quite startling as well. New home sales are at 2-year lows, mortgage applications are at their lowest since 2000, and home construction starts are down to the lowest in over a year. In the auto market, subprime delinquencies are at 10-year highs, and both subprime and prime repos or repossessions have doubled since 2020. Mortgage rates are high, and inflation is currently hurting everyone's purchasing power. When it comes to consumer spending, there has been some trouble brewing there as well. So Walmart, as I said earlier, recently cut their profit outlook. They state that inflation is, quote, affecting customers' abilities to spend on general merchandise categories and requiring more markdowns to move through the inventory, particularly apparel. This news, when it broke, sent some shockwaves throughout the entire market, but honestly, it's not too surprising at this point. It matches up to what AT&T said in their earnings call last week, which reported that they were having some troubles with customers not paying their phone bills on time. They stated that, quote, it's taking about 2 more days than last year to collect customer receivables. Albertsons, which owns Safeway and Vons, among others, also recently reported that people are migrating very quickly to the cheaper private label brands. The main takeaway from all these companies is that inflation is changing consumer preferences and also how consumers are paying at checkout. Consumer debt is trending higher, and it's safe to say that this trend may continue as the effects of the stimulus disappear and inflation eats away at people's savings. All these are indicators that the economy isn't doing so hot. But there is one bright spot, and that's the labor market. And this is what's really confusing because unemployment is at 3.6%. That's the lowest in over 50 years, and even though there's been some high-profile layoffs in the news recently, that has mostly been in the tech industry, and we haven't really seen it in the overall labor market. That brings the big question of, will we actually feel the effects of a recession with such a strong labor market? Most people would say yes, but one thing is for sure though, the current environment that we're currently in doesn't look anything like 2008. In 2008, people with little to no credit history were able to buy homes with subprime mortgages, which led to massive counterparty risk for the banks. Today, there's no real big structural issue like that one that we had in 2008 in today's world. Some could argue that the auto loan market is getting a little bit out of hand, with total auto loan debt doubling from 700 billion to 1.4 trillion. And others will argue that the massive inflation might actually cause us to go into a recession, but that's only because the Fed might raise interest rates so high. Household balance sheets are still strong right now, and the savings rate is much higher than what it was back in 2008. Now, if you compare now back to the early 2000s and the dot-com bubble, that recession was more of a stock market correction more than anything. Back then, the NASDAQ reached a price to earnings ratio of between 175 and 200 and was bound for a correction. Fast forward to today, at its 2021 peak, the NASDAQ hit around a 30 price to earnings ratio and is now sitting at 22 times earnings. It just also doesn't feel like a recession because people can still get jobs. However, everything else is getting super expensive, and a lot of people can't afford gas, food, healthcare, and have money left over for discretionary spending. There are a ton of people right now making sacrifices while the cost of living gets extraordinarily higher. We aren't sure what the long-term effects of this year's inflation is going to be, but I reckon in a few years' time, we're gonna have a lot better of a picture. All right, so what might happen over the next year? First off, the Federal Reserve will continue to raise interest rates. The federal funds rate is the rate that the central bank charges to other banks. Just like you and me, we're the bank's customers. Well, banks, they're customers of the central bank. That means they can deposit their money with the central bank and earn an interest rate on their reserves. So when the federal funds rate is increased, a bank like Chase might be able to earn more from the central bank instead of loaning it out. So if they do loan their money out, they need to raise their interest rates, and that's for any loan, including mortgage rates, car loans, etc. When interest rates rise, it directly and indirectly affects spending behavior. Higher interest rates means that businesses will find it more expensive to borrow, so there's less economic activity, fewer jobs created, and less money in the systems overall. The whole point is that hopefully spending and investment slows down so that businesses become reluctant to raise their prices, which should rein in inflation. Raising and lowering interest rates, though, is a very complex task that can raise or sink the economy. What makes it especially difficult is that even though changes in interest rates immediately impact the stock market, it can take 1 to 2 years for interest rate changes to have widespread economic impact. So the Fed could be raising rates and not fully know if it's working or if they need to raise rates even more or less. Since we're seeing more interest rate hikes for the rest of 2022, you should be prepared and know that there could be a potential for a massive downward spiral as higher interest rates slow down the economic growth even more. Not only that, now the expectation is that the Fed will cut rates in 2023 because the market is clearly pricing in an economic slowdown. So what are the most realistic money saving tips that will help you over the course of the next year or so? First, you want to go over your current budget and see what you can cut out, such as any unnecessary subscriptions or habits that aren't good for your wallet, like going out for drinks too often. Cutting your costs is the quickest way to ensure that you're in financial control, and it also gives you a good overview of how you're doing financially. The second thing I would do is make sure to keep your emergency fund flush, so keep it at 3 to 6 months of savings in cash. I know this is pretty common advice, but it really rings true in times like these. Having this cash will give you some peace of mind that you can weather any emergency if it comes up. It also ensures that you can make it through any volatile times in the market and will encourage you to not emotionally sell off your long-term positions. Third, if you are investing, try to stay the course. Personally, I keep dollar cost averaging into the S&P 500 because perspective is everything when it comes to investing. This is a pretty good time to invest at substantially cheaper valuations because 20 years from now, all of the current economic worries we have will probably just be a small blip. Fourth, try to get the most out of your money because of interest rates going higher. You'll have an opportunity to get higher rates on your high yield savings accounts, and the Series I bonds from the government are also over 9%, and I've talked about those in previous videos. If you have any suggestions on what to do to weather an economic recession or what you did during the last recession, let me know in the comments, and thank you guys for watching. I'll see you guys next time. Peace.